What's up, Outliers? Big day in the market today with a handful of things coming together, which is exactly why we have a stream scheduled. So the goal is to talk through a few things that hit the broader radar today. I've gotten a few questions about, thought it would be a good time to take a look at these. First thing we'll take a look at is the Fed rate decision, mostly just because it's super simple. It'll just take a few minutes to talk about that. Then I want to talk about some of the tariff updates because there are not a ton of changes, but enough that are worth talking about briefly. And then we'll dive into this GameStop position that everybody identified. It was funny too, because this popped up on a few of my scanners. And funny enough, if you'll notice, this hasn't been a single day thing. That's another really important note. I see a lot of people talking about what's going on with respect to the put volume that you see today. But if you go back to yesterday, there's also a lot of really big put premium. So I noticed that's being overlooked and something we should talk about because the trade that happened today itself is interesting. I should say trades, not one trade. But this is also important to identify, essentially the fact that it's not just today. So that's our agenda. Let us dive right in. This should be, I think in general, like I said, the Fed component to this should be pretty straightforward. A few people were asking me about the general stance of the Fed, which I mean is a completely reasonable question, but there's just not a lot. So let's start here. Looks like we got Bramus, Robert, Scott, Zach, and Mark. Great to see the boys. Good to see you all. Now, for the Fed statement, like I said, it was essentially what we expected. There was nothing that came out of that was a big shock. We maintained rates. That was the overwhelming probability distribution. The rate picture did notably shift a little bit for the follow-on meeting. The statement itself, the transcript itself, about the same. Essentially, what to take away from this is there's not enough shit breaking to cause a need to change. Like, that's effectively what this is. Now, they did highlight, they being Big Daddy J-Pal and his compadres, did highlight, however, the uncertainty element. Now, again, that's not like new news. We knew that. We know that there's a ton of uncertainty. The fact of the matter right now is that we're effectively talking about global trade policy through tweets. So, you can't expect that to go super smooth. And that call out is important because it plants an important seed for them. The Fed has been so deliberate, so steady, hyper consistent in their messaging, in their activity, and they're now essentially saying there is a new thing going on that if this keeps going a certain kind of way, we have to be ready to react quickly. And that tells you what they're talking about. That tells you that there is an underlying chance of some sort of quite short term, I would imagine pretty quick pivot of some sort. So the reason why it's important to take that away from the meeting is because most of us are used to this super steady state, static approach. Pretty clear roadmap, clear guidance. But you just got the warno. We use that in the military, warning order. It's a heads up. You just got the warno that shit could change pretty fast. Market will react some kind of way to that condition should it occur. So he was talking about the general strength of the market, the labor market. We're seeing about the same. Unemployment rate is about where they want it to be. That's what I'm saying. Like pretty much everything in here other than inflation remaining still high compared to what they would like overall is what they're expecting to see. Now, this is, again, the important element. The new administration process of implementing substantial policy changes in 4 distinct areas: trade, immigration, fiscal, and regulation. The reason why immigration is brought into this is because immigration is a big part of the labor force, depending on what kind of part of the labor force you're talking about. So that's why this is an important inject in this conversation. So you can see tariff increases announced so far have been significantly larger than anticipated. That's when Trump came off the top rope, gave everybody the people's elbow when he opened the conversation that was started off with everything's going to be nicer, I could have been meaner. And he starts with everybody gets 10% tariff, go fuck yourself, effectively. So that obviously did take everybody by surprise. And they're essentially saying that the policies are evolving and their effects on the economy remain highly uncertain. Again, they're planting the seeds for their capacity to pivot quickly if they need to, because they might need to. So that's one of the big takeaways that I took from the meeting today. Again, pretty straightforward. The other thing that I think is worth noting is that if we take a look at just the bond markets, a couple key changes. So next meeting is still majority probability of no cut. And then you see the first 82% probability of a cut in the following meeting. The reason why this matters is because if we go back and we take a look at the change in probabilities, what do you notice about the change in the probability of no cut in the 30 July meeting? Started off a week ago at 2.3% probability of no cut. A day ago, up to 22. Today, up to 30.4. So what this is showing you is a change in expectation around this 30 July meeting. Now, if you go out to 17 SEP, even though the probability here for no cut is still astronomically low, the fact that it's increasing like this from effectively 0.2% up to 5%, that's still important to pay attention to. And this has everything to do with how the policy has been rolling out and the potential impacts. Because from Big Daddy J Pow's foxhole right now, really difficult to have a really solid forecast expected cadence going forward until we have any idea whatsoever what these fucking trade deals look like. So that's the big question we're looking at. So the main thing to pay attention to from this side of things is that at the beginning of the year, we were talking about 6 cuts. Then it was down to 5. Then it was down to 4. And if you take a look at the total number of cuts we're projecting right now for the rest of the year, there's 1 here, 1 here, and 1 here. So we're down to 3. And it's a pretty soft 3. This is up for contention. This is up for pretty serious contention. Even the front 2 are also up for contention. So that's the big takeaway from Powell's meeting today, as far as I'm concerned. Things generally moving along as expected, no cut as expected. The uncertainty might cause them to pivot quickly as expected. And now we are waiting to see what the rest is for that. So that's what we have for Trump. Now, if we talk about the overall Trump injection into the Fed rate policy and the Fed rate policy status quo going forward, I imagine it will largely continue to be the exact same. People don't really know what to expect, and you can't forecast off of that very well. Beautiful. Next up, I want to talk quickly about not the COT report. We've already looked at this before. So, and there's no change, by the way. It doesn't come out until later. So we have a little bit of time. But I want to talk to you really quick about this here, actually. So we know that the tariff conversations with China have been underway or not underway, depending on who you listen to. But there have been some level of conversations occurring. Now, to what degree that ultimately manifests in terms of a trade deal, we don't know. One of the things Trump has cleanly come out and said recently is some of the tariffs are essentially not going to change. Now, again, based on how this thing has gone so far, you can't take that shit at face value. You don't know, because he also said that about other stuff that did change. So he is absolutely leaning into this confusion/unknown style of negotiations, but that leads us all in the unknown. I actually had a conversation earlier with Business Insider. They wanted to just talk about the markets, and I had some stuff I wanted to share with them. And one of the things that's cool about the broader policy as it sits is it is a great equalizer because nobody knows. It's not like there's some sort of big insider group at this point that's, getting the stuff in the ear right before it happens. Like, this is a freaking crapshoot for everybody. Of course, certain people will be closer to the information, but you get the point. Broadly, it's pretty even field right now. And that's because of how chaotic things are. So the other thing to keep in mind throughout the rest of the week is how do the conversations continue to flow around tariffs and around these Chinese conversations on the arrival of some sort of trade deal. Now, I did notice that if you take a look at this, the chip makers themselves really didn't, they had a bit of a rally, but it was relatively soft. And they're saying that they're planning on rescinding AI chip curbs as part of a wider effort to revise semiconductor trade restrictions. So this becomes important because there is a massive, massive, massive pull right now. I'll keep this open because we're going to need it. There's a massive pull right now for onshoring of chip production and chip utilization. So you can see that Micron actually had a pretty solid day today, up 2.6%. So it's interesting to see some of these names actually doing pretty well. Yeah, a little different than expected, especially given the tone and tenor of a lot of the conversations that are going on right now. But that is slightly promising. All right. Time for the belle of the ball, what I imagine most people are interested in taking a look at, the crowd favorite GameStop. So today was a very interesting day in GameStop, and it's because GameStop triggered a few different alerts that I like to use. And it's, again, very much from a general options trader lens. I wasn't necessarily hunting for GameStop today. I was simply monitoring the markets as I typically would. But there's some interesting fact patterns that came out over the course of the day. So if we take a look, first thing, as I already discussed at the very beginning of the stream, I know people are all very curious about the move that you saw today in the puts, which we'll take a look at. The thing that I want to remind you, though, is that this shit happened not long ago. You literally saw the same thing effectively yesterday. So because of that, the net premiums in GameStop literally went haywire. If you're looking at GameStop over the last half a month, effectively starting from here, kind of calling it, second week, third week of April, premiums have been just funneling sideways here. So then let's start with taking a look at what happened on this time frame here. And by the way, for those that were tracking this one, out of curiosity, did you guys know about this one? Like, did you guys know about the volume yesterday? What I'm curious is to get a sense from the GameStop community, like what information is permeating and how and why. Because there was a couple people that tagged me in the Discord today, in the GameStop thread, about the volume today. Okay, so Lauren was aware. So was this just not as topical yesterday? Because it's like all over the place today. Maybe I just caught a specific piece of it today. I don't know. So then maybe it's just the way Zach's also saying that they saw it yesterday. Okay, so maybe it's just what I received. Robert says, heard big put orders, didn't know 2 days ago they were bullish. Well, you can't conclude that they're bullish, first of all. So that's one thing to slow down on for sure. Lauren says it was, but having happened 2 days in a row. Okay, got it. That's what it was. Yeah, because I've seen a bunch of things. People were sending stuff to me saying like, oh my God, there was, like 18 million in GameStop puts today. This is huge. And again, it's big. But it was funny because like I was literally trading a similar effect yesterday. And again, I'll show you exactly what that looks like. I know not the trading lens, but we'll talk about the position itself. So let's start looking at yesterday. And I want you to pay attention to what you're going to see. Robert says, sure, being short in text, they were sold, not bought. They definitely were sold. But my broader point is, and this is an important thing, whether they were bought or sold, you can't definitively conclude bullish or bearish. You literally can't. And we'll talk about why that is the case, especially these kinds of positions that you saw today for sure. It's what I'm trying to point out to you, and really the GameStop community in general. It is completely smart and a good practice to say most likely this might mean XYZ. However, there's a difference between most likely and is or isn't. And we'll, again, take a closer look. So let's go back. Let's go back in time and let's take a look at what happened on the 6th of May. So here, I want to first focus on just the 6th. What do you notice? 25, 25, 25, 25. I'm not going to say it as many times as it's here. You see it all at the bid, some at the mid. By the way, this isn't a mid trade. This is part of this broader pack. And this is as the underlying is moving. And if we sort this instead by time, and let's hone in on those 95s. So I'm going to go to the strike here, 95 and 95. Okay, so we can obviously see just the massive build out inputs. So let's take a look at where this started. One lot at 10.29.25. One lot 10.29.54. One lot 10.30. One lot 10.31. One lot 10.31.24. A couple things to highlight right out of the gate based on what you see in the activity yesterday. This is price insensitive movement. The reason why this is price insensitive is because they are scaling into this position in a very great many small trades. And it gets built in slowly throughout literally the course of several hours. Started at 10:29, ended 12:59, essentially right up to the close. This happened all day. So here's the first series of trades that you can keep an eye on. And again, we will tie all this together with a bow in a little bit. Let's go back to sorting by premium. You can see essentially all of these were the majority of what came through. Now, let's zoom this into the last 2 days. What do you notice here? You should notice that it really started yesterday, ran in almost directly up to the close, and then stopped. And then just chilled out at the 95s. The 95s took a complete pause at this point. Now, if we zoom this out to a 2-day, we'll go to the 15-minute time frame. You can see where the net flow essentially starts really strong for the underlying in total. But then the put side really starts picking up the slack towards the rest of the day. So a couple things to note right out of the gate. The first thing, this was done over a really long-term time frame, relatively speaking, to put on a position of this size. This was effectively done over the course, again, of several hours. You don't do that if you're trying to fly under the radar. The other thing you don't do in that instance is scale in these very methodical sizes, just almost continuously, because what they're doing is consuming all of the liquidity that's available at that strike at that time based on the size provided. Now, if you try to put on the total size trade that you might want to put on, that's difficult because you have to put on a large order. Typically, you break it up into a few pieces, but then you can start getting your face ripped off a little bit. And you can see that start to happen, right? So if you take a look at the average fill price, they're consuming all of the liquidity with those orders, but then all of a sudden price starts going up. What's happening here is the other side of this trade, likely a market maker, is offering up what size they want to offer up. But then as they decide, this is pretty one-sided order flow. I don't necessarily want to be stuck on the opposite side of this entirely. Price starts going up a little bit. This tests how sensitive we are to price. Because again, if you take a look at the underlying price movement over this time frame, one of the reasons why this even dipped down like this, it's not because they were consuming liquidity and, the market maker was just being nice about it. If you come over here and you look at 1030, what started happening at 1030? The underlying started to go up. Now, again, the underlying is not going up massively, but it's absolutely going up enough that it helps offset some of this volume. Because if the underlying had stayed static, rotated sideways, something like that, these would have gotten increasingly expensive. But because the underlying is going up, that actually helps offset some of this order flow. So that could be part of the reason why you saw it broken up the way it was, versus coming in, slamming, grabbing as much as you can with big order blocks. You can try to ride this intraday flow in this way of the underlying, not the options, to get slightly better fills for the position that you're trying to get on. That's part of what you see going on here. Now, if we take a look inside TNS, which we looked at on the other side, but I want to show you a couple key traits. One of the things is if you take a look at spot price, which is the price that they transacted this trade at, you'll notice that the spot price is like 69.15, 69.10. It's kind of static in like the 69s. But if you go back to the beginning of the day, it started at 69.10 and the underlying here was trading at 26.12. So the underlying starts oscillating sideways a little bit as they're layering into this position. Why does this matter? It tells us that this is a very purposeful position that's being put on, not for some sort of short-term sensation seeking or short-term mispricing or short-term vol component. That's also why you see these as far out in time as they are. So this is the 95s getting built out in the first expiration of 2026. This is all from yesterday. Now let's take a look at today. If you take a look at today, and again, we sort this by premium, what do you notice? Very interesting, similar trade sizing and frequency yet again. We see things in like the 10 to 25 range as far as lot sizes. And now we're crushing the 105s. And you can also see that the 125s were involved in this a little bit, but much less so in terms of the aggregate effect. So if we click into this and we take a look at what happened today, a couple things stick out to me that are very different than what happened yesterday. The first thing is notice how it starts much earlier. The other thing is notice how it's pretty much sustained throughout the entire day, but then there's like a hard cutoff in the 1230 to 1240 handle. It's not going straight into the close. This tells me that it's likely that the position went on ultimately at the size that was desired. It didn't need to be chased into the close like what you saw yesterday, which looked like they probably wanted more. Now, if we think about why this kind of position, what's the rationale? Why would somebody want to put this position on? There's a few standard reasons for putting on trades of this general flavor, let's call it. Now, these reasons can be multifaceted. And one of the things to pay attention to is that a common mistake traders will make when we're trying to analyze stuff like this is we'll say, oh, this is a bullish position for these reasons. It very well could be a bullish position. However, it's really important to always remember the context of we don't know what else is in the portfolio and what place this has in that broader portfolio. We have no idea, which is a really important element to this equation. It's why you can't look at positions in a vacuum and essentially say, I think this position means blank. You can postulate that, of course, but you have to remember, you have no idea what this is fitting into, what the broader portfolio looks like, and what this might do or what reason it might go on. So let's start there with what kind of reasons we might see. So the first thing I thought we could do for that is actually go back into this. Well, first, let me see if you guys have any questions on what we talked about so far. I know that that's a lot. That's like a decent overview, I think, and we'll talk more about it, obviously. I want to show you a few things, but let me see if you have any questions on what we're seeing so far. Brayman says, do you think it's a good thing that as the stock market drops, GME goes sideways or goes up and to the right? If so, how come? I don't think it's a good or a bad thing. I think you can't really look at it in that way, in that small of a vacuum. You have to look at it a little more holistically than that, because there are periods where the market goes up and GameStop might be going down, or there are periods where the market might be going down and GameStop could be going up. And most of the time when we're referring to quote unquote the market in this context, we're probably talking about the S&P 500 index. Now, the S&P 500 index is very tech heavy. It's over 30% tech. So tech is actually a very different business than what you see here. So the correlation between them will be quite different. And it's also the reason why, if you take a look at a broad market indicator like this, net highs and lows. So this broad market indicator that looks at net highs and lows is showing you the relationships between the New York Stock Exchange and the NASDAQ. New York Stock Exchange is green, NASDAQ is purple. What do you notice on today, even for an example? The New York Stock Exchange has a net high-low of positive 22. The NASDAQ has a net high-low of negative 53. So what this is showing you is that even between NASDAQ, a little more tech-heavy of an index, and New York Stock Exchange a little bit more broad, that tech is slowing down a little more broadly. So it's not so much that, quote unquote, that the stock market is dropping and GameStop is going up. Right now, what's going on is tech is broadly going down, which is driving down some of the key stock market indices like you see here. So in a small vacuum like this, it doesn't mean one thing or the other. What matters for that kind of thing is how it behaves more reliably over duration. And there's actually a great example of that, which let me take a look, because I actually don't know what the year-to-date performance is for GameStop. If any of you do off the top of your head, feel free to throw it out there. But I actually don't know. Let's do year-to-date. It opened here-ish. And it closed here. So it looks about down 18.5%. So if we look at this over a longer term time frame, with GameStop down 18.5%, that's actually really underperforming the broad market in terms of where the broad market sits right now. The broad market, S&P 500, is down 4.8%. Small caps, it's much closer to small caps in IWM as a comparison. That's why I normally compare the two, not because this is a small cap stock. It's not, but it behaves way more like that cohort than anything else. So IWM is down 11.4%. So this has obviously a slightly higher beta than that. So you'll see it down a bit more. And then Qs are down 6%. So that's a big part of what you see going on here. Is just the broader market is down longer term. The things like GameStop are down more. And GameStop is a company from a fundamental perspective is in a challenged position. It's going to be in a challenged position for some time. The reason why it's challenged is because this isn't going to benefit from a high yield environment. It's not going to benefit conversely from an inflationary environment. It's not going to benefit directly from the tariffs. The tariffs aren't necessarily going to hurt it too much, but it's not going to benefit from it, although its supply chain will absolutely be susceptible to it. So from a broader economic position, GameStop's in a tricky spot here. Now, again, it still has, fun to use the term, it still has a trump card because it has cash. And by investing a little bit into crypto, it does create a little more of a non-correlated return source, which is great. So to summarize that really long soliloquy for Bramus, I don't think it's a good or a bad thing. I think the way that they're behaving is the relationship is what I would expect, and it's broadly decoupled. And GameStop will continue to be a higher beta name, which is a big reason why in my portfolio, where I'm trading the covered strangle, it's doing really well comparatively. And it's literally for that reason. It's because it's a higher beta name. I don't need it to go up a whole bunch. It's especially from like a options trading lens. I just put that video out pretty recently that talked about the year-to-date performance in GameStop. But I mean, as a percentage of the portfolio, it's doing quite well. And relative to itself, even with the downticks over the last couple of days, for the return on invested capital, it's up 18.7%, literally up. Whereas the stock itself is down quite a lot from when we started this exercise, where I'm doing like the covered strangle, thing for you guys. So yeah, I think that's important to pay attention to with the way that GameStop has been behaving, is just stock in general. Moro says, I like that Ryan and the rest of the board bought the dip. Well, when did they buy? Because I thought they bought a little while ago. When did Ryan Cohen most recently buy shares of GameStop? I don't remember when they bought. I know that they bought, fairly recently in this time frame. I thought it was like shortly after earnings. April 3rd. Literally bottom ticked it. Yeah, he absolutely bought the dip. And he bought 500,000 shares at 10.78 mil. Yeah, he definitely did. I was going to say, because I thought it was like a little bit after earnings. So yeah, that's exactly right. Cohen's consistent investment in the company is undeniable, right? You can't look at it any other way other than being extremely consistent in investing in the company, which I think is fantastic from a leadership perspective, without a doubt. Ultimatum says, are there any effects on the options chain generally from this kind of behavior? Not necessarily on the option chain. Now, it does draw sharks to the water, right? Because you can view the behavior that you've seen over the last couple days. This is anomalous. So again, people like me that monitor the markets, when we see this, we're very interested. And you can actually front run this kind of order flow with how consistent it is. Now, you're not necessarily going to make an insane amount of money on it, but it's enough that it's a pretty decent payday. But if you take a look at the overall changes in the options chain, I think this is from day over day. The bulk of what's happening here, funny enough, from a premium perspective, is actually stemming way further out in time. And a lot of it is stemming from those put positions, but there's actually quite a bit of call positions being built out as well. So the options chain in general is starting to come to life a little bit more. Now, going back to what these positions might be and the potential net effects of them, let's take a quick look. We'll build this back out to the last 2 days. We'll just do the last 7 days because they'll be at the top. And let's start with the 105s. We'll take a peek at these. So we can see that the volume on the day was 2692. Now, again, all of that volume is not one place because there are other people like myself that are involved in this mix. So I literally know it's not all of them because I'm part of that. And I imagine that there are others that are doing the same thing that I am. So it's difficult to say like what the total position is. One of the ways that we can try and see that is by looking at TNS and seeing what was grouped together. A lot of times they'll group it together like this for you and see what the overall volume was. I wonder if they have, one sec. Yeah, the fact that so much of this is over the book is interesting. I wanted to see, a lot of times they do like the grouped order thing, but I think these were executed with enough latency between some of them that you kind of can't. So I think we can estimate like what the total size was on these, right? Based on the broad metrics here. So 2692, we could say something like maybe 2250 at a minimum, might be something like that. So we have the 95 puts. And let's say that there's 2,250 of those that the entity entered into. The first thing to pay attention is the net Greeks that this is going to experience. And the net Greeks here are interesting because, again, when we're taking it back, not looking at the individual position, but taking it back to the broader story, there's a story here. So we know that these are short puts. So, quick options quiz for you all. Are short puts long deltas or are short puts short deltas? This matters. You'll see in a moment because we're going to talk about the net impact this will have on the portfolio. Reese says long, H says long. Any other guesses? We have a good trend so far. Cool. That's correct. So if we take a look at the current delta, so this will be strike, this will be lot or size, this will be current delta, this will be max delta. And again, this relationship matters. So we can figure out what the total current delta is very simply by looking at what the current delta is for the options. So we can look at it in either spot. I think it's also in here in TNS for like the most recent stuff. Delta is 95. Call it a 95 delta. That's close enough. So we know that the max delta for any one lot is going to be single, right? 1. And we can do the math to figure out what the total current delta is by taking the size, multiplying that by 100, and then multiplying that by the current delta. This represents the total delta of the position. So as it sits right now, so this position as it was put on offers a total of 213,750 long deltas. And again, this is assuming a trade size of 2250 based on the total flow that we saw on the day of 2692. So I'm just essentially taking a few hundred out. That might not have been them, but the main thing is this could be a little bit higher if more of that distribution was them. I'm just scrubbing some because, again, we don't know. So next we can figure out what the max total deltas are by multiplying these straight across. I done fucked up because I didn't multiply it by 100. My bad. Let's undo. So, I mean, funny enough, this is a pretty significant size position. And again, this one is based on the 105s. So now let's take a look at the 95s. What I'm showing you is what the total position might look like, since it does look like the trade activity looks very similar between both of these positions, right? The deltas look similar. The overall frequency, the timing looks different, but think of it this way. Remember how I said it looked like they were trying to build out more? They started about midway through the day, and then they ran it all the way up to the close, 1250 to 1. You're literally running it into the close. That looks like the position wasn't put on in the size that they were wanting. So now if we take a look at the total volume, funny enough, it looks like the volume on the day prior was 2,600, and that's from, yeah, so that's 2,600 total, I suppose. So that's what's here at 95, 2,600. We'll just say that they're the most of that block. So we'll call it 2,500. And the current delta for those, I'm just going to use whatever it was yesterday. It'll be close enough. 94 delta. And again, we know the max is going to be 1. So what's been built out here? If we want to see what the share equivalent is for the position in terms of current deltas, it's 448,750. Again, give or take, it can be slightly higher or lower. Call it 450,000. So the position as it sits right now represents about 450,000 shares of GameStop, with a max of, again, give or take, about 475,000 shares. So now, what do we think about this? What's your impression as I put this information in front of you? I show you the total position sizing as we add these two together in terms of total deltas. What do you guys think? What's going on? Why might this be happening? There are a couple really straightforward reasons, which I have to be honest, I don't really think much in GameStop is straightforward, but we'll start with the straightforward stuff because it'll be easier. But I genuinely want to know what you think. So Reese comments that it's a large position, which is absolutely the case. There's, again, no way to debate that. Robert says, how many shares did Ryan and Alan put in a Schwab margin? That I have no idea. I think Ryan Cohen, I think it said that he bought, 500,000 shares for like 10 mil? So I don't know what Alan did, though. So the fundamental reasons why these kinds of positions get used. The first one is if you want to put on a synthetic position and there's some sort of regulatory constraint on what you're allowed to hold. So there can be instances where a fund, for example, might not be able to hold shares of GameStop, but they might be able to hold options. That could be the case. Again, not saying one way or the other what's most likely here yet. I'm just walking you through different scenarios, and that is one of them. The overall purpose of a position like this in this context is very similar to establishing a synthetic long position. Now, the synthetic long typically includes a short and a long option. So creating a synthetic long using one leg is a little anomalous. Now, it can be done to err on the side of simplicity if you want to put on a simpler position, not play with as many legs. However, you have to put on twice the size effectively than you otherwise might want to, because you could otherwise play puts and calls, again, depending on what strikes you choose. So there's that element of it, which is a little interesting. Now, one of the really interesting things about this is that this position is actually not at an insignificant level of early assignment risk. It's not at a high level of early assignment risk yet, because it still has well over $1 in extrinsic value. However, that being said, there's a interesting trend here, because let's just simulate the passage of time. Right now, this is saying that there's 254 days. Let's just pretend everything remains the same, but time has passed. So what will happen is these 105s that are out in 16 Jans, again, let's pretend 100 days pass, a little less, and they will look like these 163 DTE. So there's not even any more 105s. Let me see where I can find the next series of 105s. Not here. Here. So if, again, things remain relatively steady and you look at the passage, now we're simulating about 200 days, 210. If 210 days pass, they will look like these. And this represents, again, like 20 cents of extrinsic value. That's enough that early assignment risk isn't going to be too high, but it's still there. But if you take a look at the overall profitability of the position, again, assuming that holding duration, what do you notice? The 105s that are 44 days to expiration are trading about the same as the 16 Jan 105s. So there's actually a little bit of an interesting opportunity here from a relative value play, but that's not what happened here, so I won't go down that rabbit hole. So this, to me, looks like a synthetic long position. Now, why it was put on this way, I don't know. It's honestly not super inefficient, but it's also not highly efficient either. And my broader expectation is that this is probably part of a bigger portfolio that's trying to do something specific, although it's obviously very hard to tell what, because we don't have the context. Now, I do have a small piece of context that there is a critter scratching at the door, so I'll be right back. I think he heard us talking about GameStop and he was just like, yo, I really need to get in on that. Rightfully so. I don't blame him. So this does look like a synthetic long position. Agent says, seems like buying shares is easier. Not sure why you'd go short such deep in the money puts. Well, again, one of the reasons is what I just told you. it definitely is more efficient than buying shares. That's without a doubt. And the reason why it's more efficient with buying shares is especially if you have a large account, which you have to put on this kind of position. It's not even that many options in a gross number, right? If you think about it, it's, 2,500 lot, something like that. If you have a portfolio margin account, which they absolutely would, if not better margining, because it could be institutional level, which probably the case, it literally can be way, way, way cheaper to hold that than what it would cost. Again, I'll tell you right now what it would cost for a portfolio margin account to put on a lot, and then we could do the math. Right now, the reason why I don't do it on this is because this is a pass-through IRA account, so it's not going to show us what we want, but I literally can just do it on my phone real fast. So let's go to GameStop. Let's take a look at the 16 Jans. Let's go to the 105s. We'll do. Let's look at selling in the money puts. It's asking for 7,900 bucks. So honestly, not really. It's so deep in the money that it's asking for about the same. I mean, there's a slight discount, but not much. Whereas if you look at something that's out of the money, like the 20s, you get away, it's like literally 1/10 the requirement. So the deep in the monies, they're actually asking for, you would get, you get a decent credit. Hold on. So the margin requirement on it is, it's a little bit better. It's not much. And in terms of a credit up front, let me see. What's the margin requirement? The margin requirement is $2,600. So you're actually getting a pretty decent break here. So let's again just do the math really quick. So here we have a credit amount. Here we have margin rec. And again, this is looking at a portfolio margin account. If it can be an institutional level account that has even better rates. And this one is for the 95s. So the credit we're looking at is about 69. We'll just call it 69 on average-ish, which I think is pretty close to what you saw. And then, like I said, the margin requirement is 2602. Okay. And then let's take a quick look at the one, what is the other one? 105s. So for the 105s, those we're collecting again, let's just call it like 79, maybe something like that. And the margin requirement for this 2602, literally the same. And it's not offsetting in my portfolio because I don't hold any equity right now in GameStop. So first, let's take a look at the total credit that they would have gotten, which is literally going to be a ton of money. And you'll see why this might matter. So this is total credit. $35 million in credit. Total margin requirement on these. $1.2 billion. So it's a really big account that has this, definitely institutional level. And I know that there was some conjecture like maybe it's the cat. The cat doesn't have this. Last we saw, who knows what he comes back with. Motherfucker could come back with a few bill for all we know. He kind of does that. So the total amount of money you need to secure the position is pretty big. That being said, if this money is tied up in other assets that are already being used, except you just got another $35 million to earn, for example, the risk-free rate even, or do something else with, absolutely could be the case. Now, the big thing is this is very likely, again, part of a broader portfolio play that we're just not going to have visibility into. But let me get caught up on the chat. H says, would it be a participant wanting to build a position without reporting? They still would have to. So like this, if it's a hedge fund of some sort, this still is reported out. Like options positions aren't like hidden, but it's just a slightly more efficient way to hold it, because I'll show you right now what the comparison is. If you look at the difference between if you were to like the share equivalent, this is how much you have to put up for both. And there's a error in the math for sure, but what is it? Oh, because I multiply it by 100. I'm an idiot. My bad, guys. I'm an absolute idiot. So the total margin requirement is 12.4 mil. I accidentally multiplied this by 100 because it was like, there's no way it's more than the share equivalent. So this represents how much of a cheaper position? A much, much, much cheaper position to put on, like way cheaper on a relative basis. So what this is saying is that in terms of total margin requirement, they would need $12 million. So this actually could be the cat then. And this could be, I mean, it's a lot of money, but it's not a ton of money. Like there's plenty of retail traders that have that amount of money, and there's obviously tons of institutions that have that kind of money. And again, this is using portfolio margin. If it's an institution, they can have even better margin requirements. But it's effectively putting up 12 mil, again, that you can have invested in other stuff, but you get that 35 mil in cash up front. So that 35 mil is sitting in a cash and sweep right now as it sits. So what they're doing with that money is obviously unknown. It likely wasn't done necessarily for the sake of generating that money, because the total interest that you get on this will be a little bit, well, let's see. We need DTE. Let's do here. I got to reformat this because my fucking OCD won't let me not. Okay. And these are both 16 Jan 26. So the overall duration, let's see. So We have the credit is in O. We need DTE. This is expiry. And then this will be DTE. Okay. And where's our margin? So what I'm going to do, push this down. And this will be option margin requirement percentage. This will be the percent annualized return. And to do the percent annualized return, we will want to do credit by margin, multiply that by the duration of a year, 365 over the duration by 100. So this shows you the percent annual return. So what I'm showing you is that there's not like some sort of great ARB that they're finding here. There's nothing like that. A lot of that has to do with the risk-free rate right now is already kind of baked into this. Now, funny enough, actually, as we look at it, the 95s, they got screwed a little bit. That means that they didn't get priced well because the annual return on that is 3.81% as far as the credits received. So it's actually not that great of a return there. And if we take a look at the yield curve, one sec, let me grab that for you guys here. It always fucks up the colors when I bring this over. I don't know why. We take a look at the yield curve and we look at stuff that's around 250 days. So that puts you somewhere in this space on the yield curve. There's a slight edge for this trade. This is coming in again at 4.36 down here. Again, you'll probably be like at 4.1, maybe 4.1 and change. So there's a slight edge on this trade, but negated by what was put on in this trade. So the point that I'm making is I don't think that this was a play to get to the credit. I think the credit is obviously part of it, but I think the play probably has a more defined portfolio driven reason for being placed, not relegated to what you see here, at least as far as I'm concerned. All right, let me get caught up on the chat. Why would you sell puts at low IV? It doesn't matter. This selling puts, the implied volatility here doesn't matter for a bunch of reasons. The first reason is even if volatility was high in the front, these are so far out in time that the volatility would probably be low anyways. The next reason is because these are so far in the money, there's so little extrinsic value that it literally doesn't matter. Most of what was sold was intrinsic value. Intrinsic value doesn't care about what vol is. So the extrinsic value here is such a small part of the trade that it doesn't really care. The thing to remember is like the stuff that you might have learned or heard other places, stuff like, oh, well, you want to, buy vol when it's cheap buy vol when it's cheap, sell it when it's expensive. Like that's okay, but it's such a crude such a crude overgeneralization. The other thing is, this again is not really designed to capitalize on some sort of vol disparity. It's not even capitalizing on the yield curve, really, if we're thinking about it. So, agent says, seems like buying shares is easier. Okay, so we already talked about that. The reason why the buying shares is, it's easier, but this is way cheaper. Agent says, I don't know why you would go so in the money. There would be a lot more premium extrinsic, like say at the 50s. That's the thing though, is that they're not trying to, this isn't an extrinsic value play. This is a synthetic long position. They want it to behave like the stock. They're doing it through an option, again, for a few potential reasons that we don't know. It could be regulatory requirements. It could be that they literally can't hold the share in the portfolio for some reason. But it also could just be literally for capital efficiency. This is way cheaper. It's literally 75% cheaper than buying the shares outright to have literally the same, overall the same exposure. It's off by a little bit, but not much. So yeah, this isn't, you can't apply like a standard options trader, retail trader, sell at 30 deltas that are 50 days in to capitalize on the theta decay curve. Like none of that applies here. This is a much different style position. This is definitely a synthetic trade of some sort, but for like the broader intent as to why, that's the big thing that we really don't know. H says, is there a similar level of open interest on any of the options that would constitute a long leg of the trade? No, not really. Agent says, could this be a short seller starting to close or to pass the buck to the market maker? No. There's no way that a short seller would interact well with this position much. So in terms of like, quote unquote, passing the buck to the market maker, let's take a look at that scenario. So let's say that there's a short seller, and what price do we think that the shorts are at? I know that a lot of people think that the shorts are still out there. I just honestly have absolutely no idea as to like what price we say that the shorts are at. So what price do we think that the shorts are at post split, by the way? Because obviously there's been a couple offerings. So what do you guys think? Like, what's the, from a short seller lens, we're like, what's the word on the street with what's the basis for the shorts here? It seems like we could guess through it a little bit. Futures are popping a little bit here. This probably has to do with more tariff talks, but we can deduce through it, I suppose. So if the idea is the shorts were short before the squeeze, is that the idea? And that they're still short? I imagine that would put the shorts something around, well, we have to go back even further then. Let's do 10 years. They would have been shorting from around here. So I would say shorts at the low end might be short around 10. Let's just say that they have stayed short the whole time and they didn't cover here, which again is unlikely to be the case for a bunch of reasons. I don't want to get hung up on it. We could just look at the potential context of the scenario. So we'll say that they're short around 10. Okay. Oh. $10. Yo, go away. This other thing. Stop that. So $10. So now spot price spot is 26. So this puts them $16 in the red per share. That's where that position sits today. So now if we take a look at selling to open, the 95 and the 105 puts, not including the credit received and all that stuff. We don't have to worry about that so much, because if the idea is to potentially get exercise, which I think is what some people are suggesting, then the credit itself will just be kept. But let's say that the 95s, we'll just use 100 to be the midpoint between the two, and then we'll just do a one lot. So we'll say that they sold to open the 100 puts. Again, I'm just picking the mid between the 95s and the 105s. And let's say that there's 5,000 contracts, which I think is a little much, but I think it'll be pretty close. So now let's analyze what happens. If this gets exercised, meaning the holder of the puts effectively says, I can get rid of my shares. I can give them to you. So what this would mean then is that they would have to buy to open the 5,000 times 100, 500,000 at 100, regardless of what current spot price is. So if their basis is 10, and then spot price right now is reflected at 26, depending on how big their trade is, they effectively are going to have to buy a ton of these at 100. So this position, and again, if spot price remains at 26, they're just going to get decimated, because that effectively means that it's like $75 higher than what it is. So this position itself would wash, but then the spot price on it would be terrible. So here's what I mean by that. If we look at this scenario and we just follow the math, pretending that they have the shares, let's just say that they have 500,000 shares at this price, then what ends up happening is their basis is 10. They're going to buy their basis at 10 with, again, 500,000 shares. And we're saying that they're short these. So then to buy the shares, they're going to buy to open this 500,000 up here. I'm not going to write it again because it's here, but they're going to do this at 100. So they're going to essentially make a decent trade here, right? So this is a $90 variance. But then they're still now going to have a basis of 100 when spot price is at 26. So then they're going to have essentially a $75 loss per share on the 500,000 shares. So it's not like this super slick move. There's no way to pass the buck to the market makers. It's just moving the position around. If it was from the short perspective, it doesn't do anything. And again, if the shorts wanted to cover, depending on what the idea is that the shorts are still short, they would literally just be better off covering at spot, because they literally wouldn't even be eating that big of a loss. If the average price is 10 and the stock is at 26, even at scale, right? If they shorted the majority of it, it's not that huge of a spot variance. So I don't see that very much being the case. Robert says, would Cohen need to file update 13F for these synthetic longs the same way he would with actual shares? I don't know the answer to like what the actual reporting requirements are, so I don't want to speak on it, but we can look it up really quick because it's easy. Because it does pertain to the size of the float. There are reporting requirements. We know this, right? That's also like without a doubt, but I just don't know what they are. What are the reporting requirements for an individual holder or seller of stock options? It'll be tied to like what the notional value is relative to the total value. But let's see. Reporting requirements depend on the type of account, nature of the transaction, yada, yada, yada. We already know that you need like standard reporting. Tax, no. IRS forms. Okay. No. What about IRS forms to indicate ownership? Exceeds. Mm, 13D, 13G, which is 5%, greater than 5%, if the options are exercisable within 60 days. So that looks like they're mostly talking for long options, which I imagine short options would still fall into this. But yeah, it looks like okay. If you sell or hold deep in the money calls or puts and they are exercisable within 60 days, those shares count towards your total beneficial ownership. So they do. And they're technically, I don't know what they deem exercisable. So what constitutes exercisable? Because technically American style options, they're all exercisable at any point. So I don't know what they consider quote unquote exercisable. An option that is exercisable has the right to acquire the underlying shares within 60 days, whether they intend to or not. Yeah, okay. A buyer can assign you the stock so the SEC may count it as exposures. Yeah, so options that expire more than 60 days out. So it looks like it might be based on the expiration. Yeah, so it looks like there wouldn't be a reporting requirement up front yet. So I actually don't know what it looks like when you get within the window, which is weird, right? Because there is early exercise potential here without a doubt. So yeah, I find that generally interesting. I gotta grab a water real quick. I'll be right back. There's a couple other things that I wanted to dive into with the overall positioning. All right. Morrow says maybe Kitty does want to file that doesn't want to file he's at certain percent ownership. He still would. So I think it could delay the timing for when he would have to file, but yeah, he still would have to file. Could it be related to the levered ETFs? When were the ETFs launched? When were there GameStop ETFs that were recently launched? Let's see. On the 24th. They have 5.2 million assets under management. 2 times long. So that would be done via swaps. That'll be done through synthetic leverage, not through the underlying outright. Benian says, were there any similar trades in the past? Not in the past time frame that we looked at for this. So again, if we go back to this here, and we look back over the last like 30 days, you can see even from a scale perspective, it's not there. So yeah, not that. This is a new thing that's being built out, like pretty concerted for sure. Let me see if there's any others. All right, cool. So it looks like I'm caught up on the chat. The last couple things that I do want to talk about is, so this could be a bullish speculative trade. Now, one of the things to note, and this is confusing people because I got a few questions about it. People are saying like, oh my God, does this mean, you know, like big players think the stock is going to go to 95 or 105? And it does not. It literally could just be the expectation that the stock goes up. And I'll show you exactly how that works. It's mostly because it's intrinsic value. So let's take a look at the option chain and I'll explain it out and then I'll like literally show you. So let's grab a quick tool to draw. Here's what's up. So these 105s, again, let's say that they traded for 79. The 79s here are very deep in the money. So if we look at, I'm sorry, the 105s. The 105s are trading at 79, to be clear. So the 105s are very deep in the money. So if we do the math and you take whatever the current premium is, so in this case, 79, first you got to take the difference between 105 and 2601. So that gives you 78.99. So literally the almost total majority of the premium that's in these is intrinsic value, right? It's like $79 of intrinsic value. That's effectively the total value here. And these will have a delta of 1. I know it says 38. It's because it's so deep in the money that it literally is miscalculating it based on the vol. So these essentially are a delta of 1. So while on the day-to-day theta decay lens, these will gain very little, meaning your P&L, your theta is going to be trivial. It'll be effectively nothing. So you can see that represented here. Notice how theta is about a penny, and then it goes penny, penny, penny. It literally drops to 0, and then it starts going back up again. This is because of the mispricing of vol. This is all 0 theta. So this isn't going to move much based on the day-to-day price movement. Now, this will move if the underlying moves. So let's say GameStop goes up by $5. Well, you can literally take $5 of intrinsic value out of this. So that means, again, everything else remaining the same, that your position would be trading for about $74. So that means you made $5 on that move because it's all intrinsic value. It's going to move effectively dollar for dollar with the underlying. So even if GameStop goes from 26 to 31, this position will make money. It will make this $5. Doesn't need to go to the strike. So because these are here doesn't mean that anybody thinks it's going to go to that strike or stay away from that strike. That's the cool part about options, is you literally don't have to trade them that way. So I hope that that makes sense, because I saw a lot of people kind of pretty confused on that. So anything else that you wanted to take a look at? Was there any specific element or rock that we didn't take a look under that you wanted to? Let me know. Happy to take a peek if there's anything lingering. But Robert says, any thoughts on difficulty closing the position? It won't be that difficult because it's still relatively small, but it's the kind of position that without a doubt, they are going to get punished in terms of liquidity. And that just is what it is, right? If you take a look at this, these are $1.20 wide. These are the 100s are about $4 wide. Anything that's super deep in the money like this, it's literally the perfect terminology. You're going to get punished in terms of liquidity, but the market makers will still make the market. So it's just that they're going to make you pay, and the liquidity provision is not great there. So it won't be that difficult, but it'll just be expensive. Realistically, that's the trade-off for the position. So yeah, it'll be fine overall. Nothing too crazy. Yeah, of course. All right, gang. Looks like we are all caught up. Interesting stuff on the day. We'll keep an eye on it tomorrow, see if anything continues to materialize. As always, if you have any questions, you can always hit me up. Hit me up in the Discord. It's completely free to join. Be an outlier. See you guys later.